increase total sales potential when growth potentials of current attractive product lines have largely been exploited? 3. How effective are the company's research and development efforts in relation to its size? 4. Does the company have an above-average sales organization? 5. Does the company have a worthwhile profit margin? 6. What is the company doing to maintain or improve profit margins? 7. Does the company have outstanding labor and personnel relations? 8. Does the company have outstanding executive relations? 9. Does the company have depth to its management? 10. How good are the company's cost analysis and accounting methods? 11. Are there other aspects of the business, somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? 12. Does the company have a short-range or long-range outlook in regards to profits? 13. In the foreseeable future, will the growth of the company require sufficient equity financing so that the large number of shares then outstanding will largely cancel the existing benefit from this anticipated growth? 14. Does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? And 15. Does the company have a management? And Wall Street has created its own jargon. So instead of empowering the individual investor, which Main Street has done, Wall Street has created jargon that the individual investor doesn't necessarily understand. And maybe if you can't understand it, you shouldn't invest in it. Wall Street has created terms like intraday head and shoulders top, dead cat bounce, consolidation, spread, volume, indicator, overhead resistance, fade the market, put to call ratio, the trend is your friend, sell in May and go away. They're all designed to instill insecurity in the individual investor. If you can't understand the terms and basic concepts of ownership, then maybe they are designed so you can't understand them. Don't do anything you don't understand. Turn off the talking heads and the scrolling ticker tapes. Wall Street makes 100 transactions per second, so a ticker tape is just a representation of participants trading their dirty laundry for someone else's dirty laundry. Turn off the voices of Wall Street and instead tune into the voices of Main Street. It's your local proprietors and entrepreneurs. That's who Warren admires, and that's where he prefers to invest. Unless you can watch your stock holdings decline 50% without panic, you shouldn't participate in the stock market. It's better if your mindset is one of owning a business. Don't rent stocks. Become an owner, not a speculator. In Warren's 2000 letter to shareholders, he said this: leaving tax matters aside, the formula we use for evaluating stocks and businesses is the same, identical. Indeed, the formula for valuing all assets that are purchased for financial gain has been unchanged since it was first laid out by a very smart man in 600 BC. The ancient philosopher was Aesop, maybe best known for the fable about the tortoise and the hare. But the fable Warren is referring to here is the bird in the hand is worth two in the bush. So I asked Warren, when are you going to write the most definitive book on investing? To which he said that everything that one needs to understand has already been written. investors make it far more complicated than what it is. While others with the same investment education, character traits, and aptitude choose to study capital pricing models, beta, and modern portfolio theory, Mr. Buffett instead went against the Wall Street crowd and instead studied income statements, balance sheets, capital requirements, intrinsic value, and management talent, ambition, and character. Phil Fisher sought out management and talked with them. Ben Graham believed in the contrary. He thought management would influence him to make an investment that wasn't the best. Lou Simpson, who I'll talk about later, has the same philosophy as Phil Fisher. If management won't talk to him, he simply doesn't invest. Warren said that on his company's employment application, he would have one question: are you a fanatic? He puts a premium on management expertise, where Wall Street's all-consuming focus is instead on price. And in reference to his managers, he jokingly says, if they need my help to manage the enterprise, we're probably both in trouble. Aesop, some 2,500 years ago, also told the story about the fox who had lost its tail. And the fox tried to convince the other foxes that they didn't need their tail either. The moral of the story is that you should distrust interested advice. In the New Republic in 1992, Warren Buffett was quoted as saying, "To many on Wall Street, both companies and stocks are seen only as raw materials for trades." Now, I mentioned earlier that Warren likes to play what-if games. And an example of his attitude towards Wall Street was his fantasy of dropping 25 brokers on a deserted island. 20 would be assigned to gathering food, making clothing, and building shelter. And the other 5 would trade options endlessly on the future output of the 20. Buffett has never met a man, including himself, who can forecast Wall Street. He may know what will happen, but he will not know when. He predicted the burst of the tech bubble, but he wasn't able to predict when it would happen. He jokingly says that God created economists to make astrologers look good. Peter Lynch said, if an investor spends 15 minutes studying economics, he has wasted 10 minutes. When it comes to investing, Warren has written and said over and over again, people will be full of greed, foolishness, and fear, and it will be reflected on their investment behavior on Wall Street. The sequence isn't predictable. If the Federal Reserve Chairman whispered in his ear about interest rates and monetary policy, he wouldn't do anything different. He goes on to say, I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. This value, and can it be purchased at a discount to its intrinsic value? You should ask yourself, what have been your best investments? Probably the answer is long-term investments in businesses that you understand and are on Main Street. You should make fewer, better decisions. Warren's best investment may have been NetJets, literally based on Main Street in Woodbridge, New Jersey. Rich Santulli innovated the concept of time-sharing corporate jets, where instead of an individual or company owning its own jet in its entirety, an individual or company could buy just the number of hours they need in order to fly each year. When Warren first tried the business, he called Rich Santulli and said, "If you ever want to sell the business, I would like to buy it." And Rich Santulli told me that there's only one person he would sell his business to, and that was Warren Buffett, because he knew that Warren would leave him alone and that he would be able to run the business just as he's always run the business. Warren paid $725 million for a business that will be as large or larger one day than Federal Express. You may recognize some of the owners of NetJets. Pete Sampras, Tiger Woods, and Hollywood's own Arnold Schwarzenegger all enjoy the convenience of picking up the phone, and within a 4-hour phone call, wherever they're at, their jet will be delivered to take them and whoever else they would like to transport to wherever they would like to go in the world. They operated over 140,000 flights last year, and based on the number of jets, they would be considered America's 6th largest airline. A business that Warren Buffett knew about, used as a customer, and then made an investment. Warren is the antithesis of Wall Street. How they make their money is based on price movements of the stock. How Warren has built his wealth and makes his money is based on how well the individual businesses he's invested in have done. He focuses and concentrates his investments into a few companies. He doesn't split his stock, and he doesn't believe that trading activity on Wall Street will ever build wealth. And stock splits do nothing for the economic value of the business. It does everything for Wall Street, because Wall Street has learned that a stock trading at $80 a share, if they split it into two and sell them at $40 a share, they will sell more stock. But it does nothing to the business on Main Street. Making wealth together, not at the expense of his partners, has been the philosophy of Warren Buffett. For every dollar in wealth he has created for himself, he has created $2 for his partners. And when he was asked at a recent press conference what his greatest nightmare would be, I thought he would say some insurance calamity in a business that he owned, or a major defection by CEOs because he has more CEOs working for him than any other enterprise in the world. But instead, he said his greatest nightmare was attracting the wrong shareholder. He doesn't want to advertise for shareholders and say opera inside and for people to walk in and find a rock concert. He wants to attract loyal, long-term partners and owners that believe and focus on what's going on inside the business, not what the stock price is doing on Wall Street. Loyal owners that treat employees like family. I'm reminded of the story of Buffett's investment in Jordan's Furniture and Star Furniture. When those businesses were purchased, the family managers and owners, with proceeds out of their own pockets, paid each employee 50 cents for every hour that they had worked, or $1,000 a year. So if you had worked for either of these businesses, when they were sold to Warren Buffett, if you had worked 10 years, you would have gotten a check for $10,000 out of the proceeds of the managers of the business, the owners of the business, not from Warren Buffett. Those are the kinds of managers and businesses that Warren looks for on Main Street, and those are exactly the kind of businesses that he's attracted to him. Wall Street will sell anything that investors will buy. It is not your friend. To quote Warren, "Your broker is like a doctor who charges his patients on how often they change medicines, and he's paid more not for what will make you better, but rather from the stuff that the street is promoting," unquote. And a word on buying on margin. To borrow against your stock, to buy more stock, is very profitable for Wall Street. But like Warren, you should not be in a hurry to build your wealth. In terms of debt, borrowing against your stocks, Warren would simply say, just don't do it. You should be debt-free. The more transactions that Wall Street makes and encourages you to make, the more money Wall Street makes. Your money simply becomes their money. Warren Buffett, ironically, is known as the good guy on Wall Street. He will participate in no unfriendly deals, and all of the employees are retained whenever he makes an acquisition. His professor, Benjamin Graham, is known as the Dean of Wall Street. Well, Warren should be known as the Dean of Main Street. You can skip reading the Wall Street Journal and instead read the Main Street Journal. As a side note, I knew that Warren likes to play what-if games, so at lunch, I said, "Warren, if you were stranded on a deserted island, which publication, if you were only given one publication to read, would it be?" And he interrupted me and he said, "Stranded on a desert island, I thought I'd get to have a person with me." I said, "No, you get to have a publication." He then asked me whether or not he could get the publication delivered every day, and I said he could. And I thought he would say the Wall Street Journal, and then he didn't. And then I thought he might say the Washington Post, which he's the majority outside owner of, or the Buffalo News, which he owns in its entirety. But instead he said he would have the New York Times delivered. And I was surprised at first, but then it's not so surprising that he would want a publication that would let him know what's going on Main Street, not Wall Street. At the 2002 annual general meeting, Warren was quoted as saying this: "Wall Street loves a crook. Investment bankers don't care about investors. Stock option engorged CEOs are shameless, and American business is teeming with fraud. Wall Street is the legal pickpocket of wealth." Warren Buffett's methods differ from the prevailing wisdom on Wall Street. Main Street investing is about analyzing a business. It's about concentrating your ownership in one or just a few businesses. It's about management ethics, management values, management character. It's about Warren. It can teach you. He's invested in brick, paint, insulation, carpet, vacuums, jewelry, furniture, appliances, electronics, encyclopedias, shoes, ice cream, candy, even America's second largest real estate brokerage firm. The Omaha influence and Main Street observations are most telling in the story of the Nebraska Furniture Mart. Rose Blumpkin, when she was in her 40s, without any money, a mother of 4, with $500 borrowed from her brother, launched the Nebraska Furniture Mart by taking a train to Chicago and lining up suppliers. And she came back and with one sale at a time built what is now the largest retail enterprise in the world, selling $1 million a day of furniture, appliances, electronics, and floor coverings. Warren was a customer of that business first, just a few blocks from his home. And in the 80s, he walked in and asked Mrs. Blumpkin, or Mrs. B as she is known, if she'd like to sell her business. and she sold the business, 80% of the business, for $55 million. That business has now gone on to enjoy over $360 million a year in sales. And it's about investing in Mrs. Blumkin and looking at Dodge Street or Main Street, not Wall Street. He asked her simple questions when he walked into the business. What are your sales? Will management stay on? Do you have any debt? She had none. And the business today operates with the same motto: sell cheap and tell the truth. Mrs. B and now her grandsons have forgotten that they've sold the business to Warren Buffett, and Warren Buffett has forgotten that he's bought it. And that may be the true investing genius of Warren Buffett. Borsheim's Jewelry is another example, a few blocks from his home, where Warren was a customer first on Dodge Street, and then he walked in and asked if they would sell the business. He was first a customer, then an owner, the same simple questions. What are your sales? What are your gross profits? What are your expenses? What's your inventory? And will the family managers stay on? There is no difference in buying a whole business like these two or buying part of a business on the stock market. You should ask the same questions. Warren has shifted his wealth building from Wall Street to Main Street. And when an investor makes that shift, they buy not based on price, but based on what's going on in the business. They ask different questions when they're owners. What's the strategic plan of the business? Who are the competitors? What are the long-term prospects? In the early 70s, Warren bought See's chocolate candies based in California. The business was purchased for $25 million. And today, that business on Main Street enjoys earnings 3 times the original purchase price, or $75 million in earnings. The business was not purchased to be sold, because all of the businesses Warren purchases are for life. What would you think if your local businesses on Main Street kept changing owners? Yet that's exactly what happens on the NASDAQ with a new owner every 6 months, and on the New York Stock Exchange, a new owner every 13 months. Wall Street invests in stock. Main Street invests in a business. And the story of Coca-Cola is another example of what Main Street taught Warren Buffett. The Buffett family was in the grocery store business for 100 years. They sold a lot of Coca-Cola. And Warren was able to make observations then and now by what's going on in his local market with the sale of Coca-Cola. The contents of each can are very easy to understand. Even his investment in American Express. He can go into his local restaurant on Main Street and see just how American Express is doing based on the number of charges by the local customers. And even Gillette. It's all about what's happening on Main Street, not what's going on in Wall Street. The real irony is that Wall Street looks to Warren Buffett. What works on Wall Street doesn't always work on Main Street. But what works on Main Street will always work for an investor. Wall Street is about buying and selling, and that's hard to do on Main Street. The questions you ask when buying a business should be the same as if you were buying a stock. Do you understand the business? What about its management? What about the financials? And then you talk about the price. You should read. To be a successful investor and build the kind of wealth that Warren Buffett has, you must be an investigative journalist. Bob Woodward from the Washington Post, another investment of Warren Buffett's, and of Watergate fame, once asked Warren Buffett how he analyzed stocks, to which Warren said, "Investing is like reporting." I told him to imagine he had been assigned an in-depth article about his own newspaper. He'd ask a lot of questions and dig up a lot of facts. He'd know the Washington Post, and that's all there is to it. You should be curious. Warren has suggested that it's a waste of time to get a PhD in economics. He said it's like spending 8 years in divinity school and later finding out that all you needed to know is the 10 Commandments. But you need to know what you're looking for. Know what kind of investor you are. Have investment principles. Quote, "Why not invest your assets in companies you really like?" Once suggested an investment manager that I admire, and he simply said, "It's outside my circle of competence." Quote, "Draw a circle around the businesses you understand, and then eliminate those that fail to qualify on the basis of value, good management, and limited exposure to hard times," said Warren. It's not how large, but how well defined it is, particularly at the perimeter. Don't compare yourself to others' larger circle with a fuzzy edge. In the 1995 annual meeting, Warren said, when he was asked how to be an outstanding investor, "I would take one industry at a time and develop some expertise in a half a dozen. I would not take the conventional wisdom now about any industries as meaning a damn thing. I would try to think it through. If I were looking at an insurance company or a paper company, I would put myself in the frame of mind that I had just inherited the company, and it was the only asset my family was ever going to own. What would I do with it? What am I thinking about? What am I worried about? Who are my competitors? Who are my customers? Go out and talk to them. Find out the strengths and weaknesses of this particular company versus the other ones. If you have done that, you may understand the business better than the management." When I interviewed one of Warren's managers who sold his business for $1.5 billion, and they met over an hour and a half to structure the deal, the manager told me that Warren Buffett knew more about his business than he did, and he founded the company. Warren goes on to say, "Our principles are valid when applied to technology stocks, but we don't know how to do it. If we are going to lose money, we want to be able to get up here next year and explain how we did it. I'm sure Bill Gates would apply the same principles. He understands technology the way I understand Coca-Cola or Gillette. I'm sure he looks for the same margin of safety. I'm sure he would approach it like he was owning a business, not just a stock. So our principles can work for any technology. We just aren't the ones to do it. If we can't find things within our circle of competence, we don't expand the circle. We wait." To the students of his alma mater, Columbia University, a few years ago, he said this: "Anyone who tells you they can value, all the stocks in Value Line or on the board must have a very inflated idea of their own ability, because it's not that easy. But if you spend your time focusing on some industries, you'll learn a lot about valuation." Warren missed investing in the pharmaceuticals, cellular, cable, telecoms, to which he says, I missed the play in cellular because cellular is outside my circle of competence. The most important thing in terms of your circle of competence is not how large the area is, but how well you've defined the perimeter. If you know where the edges are, you're way better off than somebody who's got one that's 5 times as large of all the value investors. But in baseball, you can be called out. With investing, there are no called strikes. You can wait for the fat pitch when the fielders are asleep. And Warren surrounds himself with players and managers who are 400 hitters, and he leaves them alone. On a typical day, he says, well, first I get up and I tap dance into work. And then I sit down and I read. Then I talk on the phone for 7 or 8 hours. Then I take home more to read. Then I talk on the phone in the evening. We read a lot. We have a general sense of what we're after. We're looking for 7-footers. That's about all there is to it. When I gave Warren my 700-page book manuscript, he took it home and read it in one sitting. He says that he's looking for one good idea a year, and has often quoted Billy Rose, who said that if you had a harem of 100 girls, you wouldn't get to know any of them very well. Your activity in investing, Warren suggests, should be reading, research, and thinking so that you know what you own, not buying, selling, and trading. Quote, we don't get paid for activity. We get paid for being right. And he has suggested that you learn accounting, that accounting is the language of business. And if you really want to know what you own, you need to know accounting. Your investments must be rational. If you can't understand it, don't do it. And in terms of international investing, Warren suggests that it's hard to know the political, currency, market, and cultural risks. To the students at the University of North Carolina in Chapel Hill in 1995, Warren said this, we love the kinds of companies that we can do well in international markets. Obviously, particularly where they're largely untapped. Would we buy Coca-Cola if instead of being domiciled in Atlanta, it was domiciled in London or Amsterdam or someplace else? The answer, of course, is yes. Would I like it quite as well? The answer is a tiny notch less, because there might be nuances in corporate governance factors or tax factors or attitude towards capitalists or anything else that I might not understand quite as well, even in England, as I might in the United States. If I can't make money, he goes on to say, in a $5 trillion market, it may be a little bit of wishful thinking to think that all I have to do is get a few thousand miles away and I'll start showing off my stuff. My friendly local librarian who helps me with my writing and research once made a profound statement about Warren Buffett. She says, Warren is a great future investor. And Warren was later quoted about librarians saying, quote, if past history were all that there was to the game, the richest people would be librarians. In the business world, the rearview mirror is always clearer than the windshield. All investors must look into the future. In 1979, in Forbes magazine, Warren said the future is never clear. You pay a very high price in the stock market for a cheery consensus. Uncertainty is the friend of the buyer of long-term values. And you need to ask questions. I'm reminded of the story of the fellow standing next to a dog, and a stranger approached and said, "Does your dog bite?" And the fellow said, "No." And the stranger reached down and petted the dog, and the dog bit him. And he said, "Well, I thought you said your dog doesn't bite." He said, "Well, that's not my dog." So you need to know to ask the right questions. Remember the story of Coca-Cola, a business that Warren has purchased that he really understands. As a 6-year-old, he bought 6 cans of Coke for 25 cents and sold them for a nickel each. As a teenager, if you'll recall, he had a pinball vending machine business. A half-century later, he became the largest owner of Coca-Cola by purchasing $1 billion, which represented 25% of his company's net worth. He invested first in Pepsi, so he knows the competition. As a side note, he told me that the University of Nebraska was approached by Coca-Cola's competitor, and they offered the university several $1,000,000 if they would change their soft drinks to the competitor, and they did. And the competitors also went to the local Dairy Queen, a wholly owned subsidiary of Buffett's companies, and they too pour the competitor's product. But over 100 years, Coke was in business before Warren made his first investment. I'm reminded of Agatha Christie's line about the best occupation your husband could be in. Her husband was an archaeologist, and Agatha Christie said that was the best occupation for a husband because the older things get, the more interested he becomes. And Warren is like an archaeologist when investing in the stock market. The older things become, the more interested he is. In Fortune magazine in 1993, Warren said that if you offered me $100 billion to take away the soft drink leadership of Coca-Cola, I would give you the money back and tell you that it couldn't be done. He jokingly says that with Coke, he's put his money where his mouth is. Quote, "Coke is exactly the kind of company I like. I like products I can understand. I don't know what a transistor is, but I appreciate the contents of a can of Coke." His office is surrounded by commemorative Coke bottles. And the day I visited, there was a styrofoam cup smack dab in the middle of his desk with cherry Coke dispensed from a fountain in his stockroom. In Forbes magazine a decade ago, Warren said, "Bill Gates is a good friend, and I think he may be the smartest guy I've ever met, but I don't know what those little things do," meaning computers. So as a result, he doesn't invest in technology. He uses a computer at home to play bridge, one of his few indulgences, and he also uses the computer to read to all day with no Y in it. He goes on to say, "For some reason, people take their cues from price action rather than from values. What doesn't work is when you start doing things that you don't understand or because they worked last week for someone else. The dumbest reason in the world to buy a stock is because it is going up. Investment must be rational. If you don't understand it, don't do it." I want to be able to explain my mistakes, he goes on to say. This means I only do the things I completely understand. What attracts Buffett to old economy stocks like Berkshire is that he knew what he owned. Wealth building requires that you know the valuation of what you are buying. You know management, you know the competition, and you know what price is attractive to buy it at. The source of material for this session is Janet Lowe's book, Warren Buffett Speaks, and Simon Reynolds' book, thoughts of Chairman Buffett. It's no different if you're buying a partly owned piece of a business in the stock market or buying a wholly owned business. They should be free of change. The average business that Warren Buffett has purchased started in 1909. There's no real difference on valuation, price, or management influence whether you're buying an appliance, real estate, an automobile, a mutual fund. It's just like dating and the engagement process when you're selecting a mate. You should know what you're getting into. And Warren jokingly says that when selecting a mate, you should look for someone that has very low expectations. And he enjoys it when his wife says, "Oh, Warren, I'm so surprised." Remember the story of Geico Auto Insurance. While still in college, on a weekend research mission, he found out that his professor, Benjamin Graham, was chairman of Geico Auto Insurance. So he took a train from New York City to Washington, D.C., and he spent the day learning about the business of direct auto insurance. What the essence of the business was by eliminating the middleman and passing the savings on to the customer. He first made a small investment, then he bought a third of the company, became a director. He then bought the rest that he didn't already own for $2.5 billion. This is an excellent example of knowing what he owned. He knew management, he knew the customers, he knew the competition, he knew what an excellent value would be, and he also knew what price he'd be willing to pay. This is possible for the small investor. A friend of mine bought a national retailer and monitored it locally. What is going on locally is probably going on nationwide. He understands what he owns. He visits his local manager, he reads the annual reports, and he attends the annual meetings. He knows the customers, and he knows the competitors. You could also do this with a national restaurant chain. And you should be careful of the talking heads on television. You don't know what their self-interest is, whether or not they be personal finance journalists or television commentators, because they may suggest buying something, and often do, just because it's gone down. What about the intrinsic value? Do you really know what you own? If Warren were to teach a business school class about wealth building and the stock market, he would simply have the students do one business valuation after the other. He would ask them if they knew what they owned. He would ask them to keep it simple, and he would have just one test. He would ask all the students how they would value internet companies. And any student who turned in an answer, he would flunk. You don't want to invest in autos just because you drive one or that you live in Detroit. So it's more than just knowing what you own. It's also knowing that it's an excellent value in a growing industry. Can you explain your investments to a fifth grader? That may help you determine whether or not you really know what you own. The wild swings in share prices are really your friend. Be careful of groupthink that is so prevalent in the stock market. Warren is often quoted as saying, "You are neither right nor wrong because the crowd agrees or disagrees with you. You are right if your principles, research, data, future projections, and reasoning are right.